Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include Fed rate cut odds, my interview with Outamation, Sapan Bafna, on how companies can streamline FHA modification workflows and eliminate compliance risks. And after producer prices yesterday, we received consumer prices today. Thanks to today's podcast sponsor, Indicom. Indicom combines mortgage AI, intelligent automation, machine learning, and intelligent document processing with mortgage operational expertise to ensure that every solution is accurate, scalable, and impactful as it is innovative. Indicom's AI-powered tools, like Income Genius, Decision Genius, and IDX Genius AI, aren't off-the-shelf solutions. They're tailored and purpose-built for mortgage operations, trained on vast mortgage datasets, and refined by the feedback of operations teams, underwriters, and QC professionals. This practical focus means faster implementations, fewer errors, and a much shorter time to value. Currently, the futures market is pricing in an 88% probability of a 25 basis points rate cut during the September 17th Federal Open Market Committee meeting, a 70% chance of a second 25 basis points rate cut during the October 29th meeting, and a 65% chance of a third 25 basis points rate cut during the December 10th meeting. The Fed doesn't set mortgage rates, but supply and demand do, and yesterday Treasuries and mortgage-backed securities sold off ahead of the producer price index numbers. It was reported that money managers began repositioning in anticipation of PPI figures. Core PPI was less than expected, leading to a slight rally in prices and a drop in rates. The thinking was if CPI comes in weaker than anticipated, the case for a 50 basis points rate cut in the September FOMC meeting will suddenly become a lot stronger. Tariff increases, decreases, and uncertainty have been an issue since late January of this year, impacting rates and stocks. The Supreme Court agreed to make an expedited decision in November regarding the legality of the Trump administration's Liberation Day tariffs. In theory, the Supreme Court doesn't care about money, but Treasury Secretary Scott Bessent has warned that if the Supreme Court decides the tariffs are illegal, the U.S. Treasury will have no choice but to significantly ramp up auction volumes across all maturities to make up for the lost tariff income. Although it's unlikely that the Supreme Court rules against President Trump's tariff activities, increasing the Treasury auction sizes will trigger two adverse events. First, interest rates will likely spike due to the oversupply of bonds, despite the Fed rate cuts, similar to what occurred immediately before the 2024 presidential election. In addition, the U.S. debt problem will exacerbate, paving the way for mass uncertainty across all financial markets. Yesterday's $39 billion 10-year reopening auction offered a litmus test of the demand for treasuries in the wake of the recent bullish repricing. 10-year rates are down more than 20 basis points month to date, but the move certainly isn't without fundamental backing. The auction was notably strong, stopping through by 1.3 basis points at 4.03%, well below the 6 reopening average of 4.41%. Demand was robust with a bid-to-cover ratio of 2.65x, slightly above the average of 2.60x, and non-dealer participation reached an impressive 95.8% versus the typical 84.1%. Indirect bidders, typically foreign institutions, were especially active, claiming 83.1% of the auction compared to 70.4% average, while dealers took a mere 4.2%, well below their usual 11.6%. Following the strong auction results, yields continued to decline, reinforcing the bullish tone. For today's interview, I want to welcome to the show Outamation, Sapan Bafna, to talk about how companies can streamline FHA modification workflows and eliminate compliance risks. Getting a solid solution matters to servicers because every day of delay in adopting compliant modification processes means higher operational costs, manual errors, and frustrated borrowers waiting for a resolution. His company is the first to market with complete integration of FHA Mortgagee Letter 2025-14 changes.
There's an upcoming deadline for the implementation of the FHA modification waterfall updates, which were part of FHA Mortgagee Letter 2025-14. Can you give some background on these modification waterfall updates and just what the industry's looking at here?
Sure. FHA gave major concessions. It all started during HAMP and then during COVID. And surprising. A lot of those modification rules were still continuing. So it was about time for FHA to sort of go back to more of a normalcy, which is what they did with this with the changes they proposed earlier in the year. A lot of things industry was also asking it to do, and that is what has happened. So the HEM programs, the COVID programs are discontinued, will be discontinued September 30th. October 1 is when we start fresh with the programs which are continuing the normal waterfalls for loan modifications, disaster programs, and then they have a new program which is called OWL. So that's what FHA has done, and there are major changes. One of the main one is no permanent modification can be offered after like until 24 months have passed. So that's a pretty important change which has happened. Earlier that was an 18-month look back. Now it's 24-month. So yeah, that's at least a high level, Robin.
Yeah, so let's look at it from the servicing perspective. What do these changes mean for servicers?
So for servicers, it's more clarity. There are, of course, with every change, there are some pluses and some minuses. The plus is clarity. They are getting done with sort of the situation where some of the delinquent borrowers may have been living on the property for way too long and have caused multiple modifications to happen. That sort of is now will come to more sort of a certainty where not a lot of cost will be spent by servicers chasing those delinquent borrowers who are sort of maybe gaming the system, or they did not have the intent. Second is a related point is an attestation. So now FHA is just tightening up in a way some kind of a moral commitment around by asking for an attestation that the borrower is intent and will complete the trial payments and so on and so forth. So I think that's a pretty important step. And some of the fees, the negatives are some of the fees for like cash for keys or the pre-foreclosure sale. Some of those incentives are getting reduced. Will it have a major impact? Yes or no remains to be seen. But that sort of is the only negative I see. Or let me not call it negative. That was something which was maybe the industry was not expecting, that those incentives will be taken away.
Well, there are disincentives for those that are slow to adopt these compliant modification processes. There's costs, there's errors. Obviously, there's room for upsetting your borrowers. Can you speak briefly on why this is important for companies to be on top of?
Yes. So yeah, so this is 10-1. Everyone is expected. FHA is expecting every servicer who supports or services FHA loans to do it. Not doing it is all those things, but first and foremost, FHA may sort of disallow the servicer servicing their loans. Penalties, of course. Delays with the borrowers are never good for reputational sort of reasons. So yeah, that it's not like you have these many months from 10-1 to implement. 10-1, everyone is supposed to be. We launched our programs to our clients a couple weeks ago. They have tested it. They confirmed it. That the programming, what we have delivered, absolutely fantastic. So again, we think there is no reason for any servicer to not adopt and deliver on it. There are some pieces which can be a little complicated, but it's all solved. And it's one of those things that industry should get behind. Overall, this is a very positive thing for the industry in moving towards more and more normalcy, standard way of doing modifications and giving faster relief to the homeowners who are really in need.
There's also a compliance portion to this, and I think that's kind of where Outamate Mods, your company, comes into play here. In terms of staying on top of compliance, why do you feel like automation specifically is critical in this, when it comes to FHA mods here?
Yeah. So first of all, great question, right? Because sometimes automation and compliance are taken as like an opposite, as if you're on the opposite end. Like compliance is about somebody checking everything which is done, and it's slow and calculated and risk averse. And automation is like something which is happening fast, which I don't even know what happened. But the truth of the matter is, today's compliance, like this FHA guidelines, 250 pages. And there are a lot of items which are servicer discretion as well in there. So, you as a major servicer A has certain leeways, and what you want to do versus somebody else, who may want to take certain things differently, or you want to take borrower attestations in a different way, or any number of processes. So the approach we took is that of putting compliance in a workflow automation box, where everything is black and white, crystal clear to anybody who is a compliance reviewer or an infosec reviewer on how the programs are being run, data integrity, data security, to how the business rules are running each and every time. That is exactly what our program from a workflow automation brings in. So just think, and if you want to see a visual of it, Devang can do a quick demo, Robbie. It will absolutely sort of the visual will tell what I'm trying to tell much better. But how we can, with a drag and drop, implement these business rules much faster than anybody in the industry today, and not just implement it, but do a very robust testing, and be able to offer it to client to do the same testing at their end. So bringing compliance in a box is very challenging, right? You never get a straight answer. If I hope you are not an attorney or a lawyer, right? But it's like, and here you need a very definitive answer, a definitive solution, which is rep and warranted, has to be compliant, and it absolutely has to be accurate, because things may happen after 1 year, 2 year, 3 year. It has to be defensible at all times.
Yes, and I think the best next steps for people would be to go to outamation.com, and they can find a demo there. You can find a demo there if you're looking for help on this issue. I want to close by asking you this, Sapan, and that is, how are we seeing servicers already adapt? Obviously, in this technological age, everybody's trying to stay ahead of the curve, and I would think that there are servicers out there that are really preparing for this, or kind of being proactive. What are you seeing among them? Any trends there?
Yeah, I mean, again, it's a spectrum, as you can imagine. Some servicers are just very big, and therefore every change is a difficult change, right? Just because of their sheer size. Some are trying to move fast at this because they started late. Some were very, very calculative, planned things, and are positioned to handle this. Everyone has to come at the same point. Like I said, right? If you're a large FHA servicer, if you're a top 50, top 100, you have to be compliant. The one clarity I see in the industry is not a lot of pushback, like we were seeing with WASP, for example, and concern. So I think it will be a smoother rollout, is my feeling, with this change. And we are there. I think we have a good industry partners, pool of vendor partners available, and we'll hopefully make it very smooth.
Well, I wish you the best of luck. I appreciate you making the time for me today. And like I said, people can go to outamation.com to learn more about how you're the first company with complete integration with this mortgage letter. So pleasure talking to you, and we'll talk soon.
Thank you. Thank you, Robbie. Thank you very much.
Today's economic calendar brought the key August Consumer Price Index report, which was up 0.4% for the month, slightly higher than expected, excluding food and energy up 0.3% and 2.9% year over year. We've also received jobless claims in at 263,000, higher than expected. CPI was expected to increase 0.3% month over month and 2.8% year over year. versus 0.2% and 2.7% previously. Later today brings a flurry of Treasury auctions, headlined by $13 billion of 20-year bonds, $19 billion of reopened 10-year tips, and $22 billion of reopened 30-year bonds, Freddie Mac's primary mortgage market survey, and the August budget deficit. Before the open, the European Central Bank was out with its latest decision, holding rates steady. We begin the day with agency MBS prices slightly better than Wednesday's close, the 2-year yielding 3.48 and the 10-year yielding 4.00 after closing yesterday at 4.03%. Lenders everywhere discussing early payoff penalties and strategies to avoid them. Normally I would say let's wrap up with a joke and some housekeeping, but it's just going to be some housekeeping today in remembrance of 9/11. We'll be back tomorrow with a joke. Thanks again to this week's sponsor, Indicom. Streamlining operations with the genius blend of automation, AI, and services, Indicom helps you achieve practical digital transformation and real operational impact with purpose-built mortgage solutions. To learn more, visit Indicom, that's INDECOMM.com.